Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series where we are connecting you to a whole bunch of venture capital firms and really talking about the world of venture investing and that sort of thing. With me on the line is the general partner of Creative Ventures VC. Champ, welcome to the show.
Thank you, Matt. Thanks for having me.
The privilege is all mine. So you're based out in Oklahoma. It's a city I haven't been to. Oakland, yeah, city I haven't been to. You know, Oklahoma, for me, it's all the same, dude. I haven't been there either. But it's great to have you here, man. It's been a bit of a process to get you here, but nonetheless, we are here today. So for our viewers around the world, Champ, who haven't heard about you and kind of how you got your start in the world of venture capital, why don't you give us the elevator pitch about Creative Ventures and, give us the origin story to how you got involved in the space?
Yeah, definitely. So Creative is an early stage deep tech venture fund investing in three main themes: climate change, labor automation, and healthcare, primarily looking for advanced technologies that can solve these global crises. And how we got started was about 7 years ago, at the time when the mobile revolution was sort of peaking. Uber was 7 billion in valuation, still private. And we have like two forks going to the wood, right? One, we could go into doing B2B SaaS, which is Gazillion Fund doing that right now. Or we could do something more interesting. And, we picked deep tech, not because we love the technology per se. I mean, all of us are PhDs, advanced degrees in engineering and whatnot. But because we saw these impeccable crises that needs to be solved, and it just needs to be solved with deep tech. So we just can't use software to solve everything, unfortunately. And that's how we are where we are today.
So when you say deep tech, what does that mean for our viewers and audience who don't really know what that means?
Yeah, the two cents that I got is sort of like, you can think of it as sci-fi tech in some way, right? Things that, the Jetson would probably seen a Jetson. But really it's technologies that's been incubated for like 10, 15 years in the research labs that is about prime ready to be commercialized. So when we look for deep tech investment, the one key thing is really be able to distinguish which one is still in R&D and which one is prime for commercialization. Distinguishing features is that when you're done with R&D, you should be able to, with a pretty high confidence, estimate how much time and money you need to actually bring the product to market. Whereas if you're still in R&D phase, you don't know that because it hasn't worked yet.
Yeah, got it. It's cool. So can you paint a picture for us a bit about your investment activity? Like, how many investments have you made in the deep tech space? What's the typical check size? Where does the rubber hit the road for you guys?
Yeah, we've made about like 50, 60 investments, somewhere around there, over the past 7 years. Typical check size is $500,000 to $1 million. That's came out of our first and second fund. And then when we hit our fund 3, we're probably going to look to ramp it up to about $3 million or so. So yeah, that's roughly the stats.
Alrighty, cool. And when it comes to the stages of deep tech startups that you're looking to invest in, are they revenue generating typically? Is that one of your key requirements? Are they pre-revenue? Do they have to be focused on specific industries, or are you agnostic?
Yeah, we don't need it to be. I mean, it really depends, right? And let me expand on like what deep tech is, because I think that paints a better picture in the company. So in automation, it's essentially AI and robotics, right? It's pretty simple. In climate change, this could be battery companies, it could be sustainable packaging, it could be alternative proteins, it could be yield enhancement for ag tech, and so on and so forth. So there's a variety. And then on the healthcare side, we'll be looking at things like advanced drug manufacturing or, diagnostic technologies, med tech, stuff like that. So there is a wide variety of things that we do look at. And consequently, you're not going to expect like a med tech, company or pre-FDA to have in revenue. Whereas, you probably will expect, an AI company to have some revenue when they talk to us. So it spans a little bit, but the key things that we look for is ability to preempt the product market fit. right? Because the stage should be invested in is sort of like late seed, post seed kind of thing, seed to late seed. You don't want them to be at the A stage yet, because otherwise then you're competing with other Series A firms. And Series A is supposedly when you already found the product market fit. So when you invest a stage earlier, you're looking for early signs of success, and early signs that confirm the thesis for your investment. But you don't want it to be totally proven out, because then, theoretically it will be priced in and they'll be racing Series A.
Yeah, it's a great point. So what makes you guys different then? What do you want the world to know about your firm that makes you guys unique or special?
Yeah, I think the way we look at investments, typically when funds look at investment, it's all about team, right? And there's nothing wrong with that. And I think it works very well when you're investing in software, mainly because things doesn't work well in software. You can pivot, you go back for a weekend, come up MVP, go out, test in the market, and do all of that. That doesn't work well in deep tech. When you do the research for 10, 15 years, it is a solution that you've come up with. You can't pivot that well. So what you need is to be very precise on the market. So what we do is we reverse engineer. Instead of starting with a team and then say, hey, we invest in the right team, they'll figure out the market themselves. The way we do it is say, hey, let's figure out the market. Then let's figure out the technology that we can invest in. Then, let's find a team who can deliver the technology in a playbook. So the way we do this is essentially take out these trends, right? Labor automation. We'll look at for like different labor shortages. And we ask ourselves, hey, where's the great labor shortage that needs to be automated? We'll list out all the jobs, trying to understand which opportunities are automatable, and we'll look for investment in those areas.
Mm-hmm. So a lot of talk about the economy right now as Silicon Valley Bank's in the news today. I mean, oh my God, when SVP hits the dirt, makes you wonder what's going on there in terms of investing. I know a lot of funds kept their money with Silicon Valley Bank and startups, and now it's all looks like it's gone up in smoke or about to be. So that's a side distraction to the question, which is, it's like it is, funnily enough, it's a great precursor, because this is actually the questions that I want to ask you now is around the role of the economy when you make decisions, because seems to me that there's uncertainty everywhere these days. And so with your general partner Capon, do you care about the economy, and how does the role of the macroeconomy impact how you approach deciding whether to cut a check or not?
Yeah, as an early stage, kind of separate this. I mean, there are obviously linkages between what's going on in the macro to like early stage, right? But obviously it's delayed, right? So from the public market to late stage, buyouts probably like a quarter, right? And then from there to growth is like 6 to 9 months. Whatever is happening downstream, it comes up to the upstreams, but there's a very big delay. When you get to early stage, to seed, you kind of beg to wonder like how much of these matters in the long term, right? Because when you invest in a company 5-7 years, if the company is not durable enough to kind of go through the entire cycle, we shouldn't be investing to begin with. Granted, it's not always going to be durable, right? There's certain companies that's going to do better in certain macroeconomic condition. The way we think about it has to do with the way we construct a portfolio and not at the individual investment level. But what we would do, obviously, is we might tilt certain way. So, like let's say, hey, there's a great labor shortage right now. Let's look for companies. Let's look for automation companies. We think that there's certain regulations that's coming up, like IRA, and whatnot. We might preempt it, and try to invest in climate tech company before that. So there are certain pieces that we try to bake in, and we'll tilt the equation one way or the other, but it wouldn't impact the way we look at individual companies. And then again, like sure, there's capital crunches and whatnot. So in time of high uncertainty, you probably want them to raise more money, the less, right? There are some of those factors that changes the equation a little bit, but it wouldn't like entirely changes the way we allocate.
Yeah, it's very interesting. And you obviously talk to LPs. You'd have to be to have a fund at all. But obviously, this is a conversation that you have when you're wanting to, as you mentioned, raise your next fund. So, how does this economic narrative impact the LP's perspective on which funds to back or not?
Yeah, and I'd say this is how I describe the world, right? From 2022 until now, essentially we were running 100 miles an hour. Suddenly we start spinning for no reason, and then we stop spinning, but the world is still spinning around us. And now we're still kind of waiting for the world to stop spinning, even though we stop, right? But people are still trying to get the bearing. So I've heard from the LP anywhere from this is going to be the best vintage in ever since the '08, and we're going to go and allocate as much as we can to we're holding 50% cash because this is not the bottom yet, and we're going to wait for the bottom. So it's a very big spectrum compared to like when we first started the fund, started raising fund 1 and 2. It's basically we're going up to the right. Yeah, and basically we're just looking for the best manager we can source. It's a very different conversation right now, and people are still trying to figure out. You just sort of have to deal with it, even institution, because for institution, there are people who basically would tell us, you know what, we basically have to do denominator effect, but we're underfunded. So yeah, we basically if we invest into bonds now into 10-year treasury, we'll hit the 4%, 5%, whatever we need to hit, right? But then like we hit the annual target, but because we're underfunded, we can't pull back from venture. So we're gonna have to plow more into venture. We don't have a choice there. There are like these weird random scenario that's happening as well. That you would think that okay, they have the denominator effect, they would have to pull back, from private. It's not necessarily the case. Yeah.
Thank you for that. So when it comes to evaluating opportunities, you obviously, I would imagine, get pitched quite a lot, especially now. And so I'm curious to understand, how do you find startups to invest in, and what factors go into you deciding to cut a check or not?
Yeah, I mean, obviously, network is a big important thing. But strategically, we cultivate relationships with university, a lot of leading university, different professors are known to kind of spin off companies. By the virtue of us doing deep tech, basically you need to know the source of the tech, right? Which is university. So that's been helpful for us. And then, seeing companies applying for different government grants, we basically are the reviewer of these government grant agency, DARPA, RPE, NSF, and whatnot. So you kind of see companies kind of through that route, and you've been talking to them, tracking them for years. As far as how we think about investment, right? It comes back to the thesis. It comes back to, are they solving long-term secular problems? So, for example, we wouldn't just look at companies that are trying to improve productivity for productivity's sake. In my past life, working for bigger corporations and doing technology sourcing, even if the problem is big, but if it's not changing in magnitudes, if it's not growing, you kind of got a numbing effect, like, it's business as usual. It's fine to have these problems. Whereas, hey, if these problems are growing every day at an alarming rate, even if it's a small problem, people do pay attention, people do notice it. So that's what we look for, is are there long-term secular trends driving these problems? Not just, in size, but the growth rate of the problem should be expanding, increasing, because that also corresponds to changing market size and, the growth rate at which the company will be able to kind of ramp their revenue. So that's the number one thing that we look for. Then from there is essentially, hey, do they have enough technological advantage to kind of hold off competition for a couple of years? Because we just don't believe that there might be a couple of companies in our portfolio, like 10% maybe, that has very strong breakthrough. But it's even in deep tech, it's rare to actually find those. What we wanted is basically that disadvantage buy them a couple of years until the competitor catch up. But by that time, we want them to be able to implement with the customer and get baked in. Similar to how basically if your companies buy Oracle and Salesforce and you implement that, you're not going to get away from that for a long time because you have invest so much resource integrating, getting implemented, getting rolled out. It's a lot of work. So business lock-in is actually a much more durable long-term advantage than just purely tech. And then you can kind of do other things on top of that and get them more locked in and stuff. But first orders, get a couple of years and then lock them up to long-term business contracts and just basically sheer pain of having to re-implement things. So those are probably like the two main things that we look for. And then obviously after there's a team and other, unit economics and other more standard stuff. But for us, it's really starting in a market and then looking at, how well can the technology solve this problem and what economics come out of it.
Got it. So where does it go wrong for you? So when you are being pitched by whoever it might be, where are there commonalities in? So if you think about like the last 50 guys you said no to or girls you said no to, what is the commonality between them? Where does it go wrong for you?
Yeah, I mean, why don't we invest?
Yeah, so like when a startup's presenting their pitch to you, where does it go wrong typically?
Yeah, the biggest common thread is it doesn't fit our thesis, right? We have a very defined thesis in terms of what we look for. I'll give you, and because of that thesis, and when we do the research, we'll have like specific investment criteria depending on whether we invest in concrete automation or or advanced drug manufacturing company. Those would be very different investment criteria in terms of what we look for. So we do get that specific in terms of those vertical and those focus areas. But typically it's a very common thing where, especially for deep tech, where people don't think that deeply about the market and the customers and who they are. But then if I know founders are basically get coached around that. But the thing that there's one step into the market issue, right, is the market structure. Because then, if you ask them, all right, you're trying to sell to, so-and-so segment, but like, who do you actually sell to? What's their level? What's their approval budget? Who use the product? Who buys the product? Who use the product? Who benefits from the product? Because there could be three different things, three different people in the healthcare in system, for example. You have payers, you have pharma, you have patients, you have doctors, you have nurses, you have hospital administrator. All these incentives have to align, and you need to actually understand the ecosystem very well, right? And then I'm just going to use healthcare because it's the most complex thing ever. Then from there, you also have to understand the FDA, the different university hospital, the different from from other kind of hospital systems. And then you start to kind of like chart out, getting that product to market goes through so many different stakeholders, and everyone has to win in order for this to actually see the light. And that's when people don't have a good answer for. And it becomes, like, go back and figure this thing out and come back, talk to us when you figure it out. But
yeah, especially anything in the healthcare space, especially hardware, is a nightmare.
Yeah. Healthcare is hard because incest system is, to be honest, is really fuck up. But you can have the most amazing things, and if one person doesn't benefit from it, then they're just not going to use it, and so you kind of get stuck, with that.
Yeah, that's cool. Champ, listen, when you think about your biggest success and failure when making venture investments, what would you say has made the difference?
The biggest success and failure and what makes the difference. No, that's a very interesting. It's a very interesting question. It does comes back to the team, right? And it's not that the team is like amazing. I mean, obviously it helps if the team is amazing, but I think that the ability for the founder to have a very frank and open conversation goes a very long way, right? Because, let's face it, founders are they're not superhuman. I mean, they are superhuman, but they're not. There's certain things that you're just not going to be good at. how receptive are they at actually listening to that would determine what people tell them, right? Because it's not easy for VC to kind of walk up to them and say, hey, you kind of suck at X, Y, and Z, right? Because you want to maintain a relationship. But the more open and receptive they are, the more suggestible they are, the more likely we're going to be able to have that frank conversation with them. Because, for every 10 founders they see, we see like 1,000 of them, right? So we have a lot of data points, and be able to have that conversation with them to point out, hey, you know what, you can tell the story, right? It's not the issue when you fundraise, but the mindset when you tell the story is different. The energy, the persona is different. It doesn't feel larger than life. And having that deeper conversation with them, because, a lot of our founders are more PhDs, engineers and stuff, it's a softer issue. And sometimes it attacks the ego, right? What do you mean? Like, I'm not inspiring leader? I'm not an inspiring founder. I'm like, no, I'm not saying that. But, the way you come across it is just, it doesn't feel larger than life. There's not that excitement. And these like difficult thing are difficulty even to talk to, right? Or when they're about to like expand and scale the company and they have no basis of what their culture and values are. And we already know, oh my God, you're going to hire the wrong people because you don't really know what commonality values that you look for. And you're going to go from like 20 to like 80 people in the next 6 months. It's a recipe for disaster. But the receptiveness of the founder will determine how well they can actually avoid these pitfalls. And it's not just between the VC and the founder, it's the founder and other people. So we're fine if the founder are receptive to someone else, as long as there's someone else who's going to tell them that, hey, they're fucking up and what about to fuck up and basically figure a way to avoid it. We're fine with that. It's the founders who actively want to be right all the time and want to show that they know something. Usually that's difficult to push in the right direction, and it doesn't end well usually.
Yeah, definitely. It won't. It's impossible. Like, you actually have to have a shared set of values, I would say, and at least, you need to be adaptable to like other people's perspectives, because at the end of the day, I mean, it takes two people to dance or party, right? Like, you can't just have the investor or you as an example thinking one thing and the investee or the issuer thinking something else entirely and not being able to kind of meet in the middle. That always creates conflict and a terrible investment opportunity for both of you.
Yeah, definitely.
So, Champ, what's one piece of advice you would like to give a founder when it comes to raising venture capital today?
Yeah. The word today is what makes it very difficult. I mean, as we
okay,
just
tomorrow, make it tomorrow.
Today is like apocalyptic day almost.
Just pick a piece of advice. Let's go for it.
Yeah. You don't have the answer for everything, right? Make it a conversation. I think that a VC is not expect you to have like figure everything out, right? It's impossible. But having intelligent thoughts around it, be able to kind of bounce and say, yeah, we're considering, let's say, there's this question, once you go to market, right? This is what we think is the best one. But we're also considering this, but this is our main hypothesis. The answer is we don't know, but this is what we're going to try. And these are the priorities. If you have that, that's fine too. You're not going to figure everything out. You're not going to know this will work 100% for sure. That level of certainty is cockiness. And if you know that you already have product market fit, right? You should have a sense of skepticism, but you should have a clear hypothesis why this would be a good hypothesis, and be able to, to convince the VC that this is worth backing. But if it doesn't work, this is when we will know it doesn't work, and this is how we're going to pivot and go on next. So it's almost like designing an experiment, right? You want to know what it is you're gonna test, but you kind of want to know the result in a time frame. These things are going to come to fruition, especially these days when money is not free anymore, when burn is very limited. You want to know within what time frame before you pull the plug and figure something out. And most people do not have that in their mind. Most people kind of know, all right, we're going to do this thing. but like, how long would it take to kind of like to know this? We don't know. Oh, like, then how much money are you going to raise? We don't know. A year and a half, 2 years, because everyone else does that. Maybe it makes sense for you. Maybe it doesn't. Especially in these days, because there are bridges, right? You need to think about bridges. When you raise a bridge round, it's different from raising a full round. It's different from when you're between raising the A and the B, right? So having that thoughts in minds and having those different options and priorities are super, super important. And then have a conversation with a VC, talk to them about, so don't just try to sell it. Have that conversation, genuine conversation, because that's a conversation that hopefully you will have post-investment, right?
Yeah, that's awesome advice. Cool. We're going to take a quick break, guys, and we'll be back. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. So, Champ, I'd love to talk to you about capital structures. You've cut quite a few checks over the last couple of years. So do you have a preferred or most common type of capital structure when making an investment? Do you, is it safe note for pre-revenue, convertible note, or any kind of other, participating preferred structures that you work with? Where does the rubber hit the road for you?
Yeah, ideally with like an equity round, because then we can kind of like flesh things out, and then you'll kind of see things better. When you have a safe round, especially like if it's like sort of rolling safe, it's difficult to kind of estimate your actual ownerships and other kind of stuff. Not that we care that deeply about ownership for various reasons, but it does helps to kind of to have that flesh out. But there are other things like the board structures. It's getting understanding sort of like the what the option pools are going to be and all of that. It's just cleaner. And even as long as safe has been around, there hasn't been like too much cases of like what if like we go to litigations and whatnot. In the worst case scenarios, what happened in those realms. It's a easy, quick way to close the round. But for us, we prefer to lead the round, so we don't mind actually like doing the work and pushing it and getting the right co-investor and everything. So that would be our strong preference, but then it depends on the kind of round, right? If you're just like doing a small bridge round, like 2 million, whatever, then it doesn't matter to kind of like do the whole equity thing. But in terms of an actual round, right? If you want to deal, then equity is our preferred method.
So how do you price an equity round then?
That's $1 million question.
Yeah, I know. You just give me $1 million answer.
Right. Yeah. No. That's a great, like the real question is comp base is what we're seeing in the market. And the startup has to think that it's not about your company alone. It's just like anything else. It's your company related to others. Like just as a VC fund, it's not just how well you do, it's how well you do related to other people. So from investment, you have amazing companies, but the price is just really, really not great compared to other 5 opportunities you see. It does influence, right? It doesn't mean we want to invest. It just means that our expectation would be different because there are other opportunities that we also see that we could put the money into. So it does kind of follows that, but there are other consideration, right? So the way we think about this is first, how much money do they actually need to actually execute the milestone? That's the most important thing. You don't want to bump the price down or up and then change it, and then it changes the amount of money that they can raise, and then they're not going to get to the milestone. That's just recipe for disaster. But so once we figure out the amount of cash, then we look at sort of the dilutions across the board and kind of ask ourselves, hey, what's acceptable here relative to obviously the attractions, what we're seeing in the market, different comps and whatnot. And we kind of go from there, right? So it's a delicate matter, but price is one thing, right? Option pool is another thing. We care a lot about option pools, which is somewhat, I mean, you can think about effective valuation, when you make an option pool. We want to make sure that not only are the founders like getting diluted fairly and in a way that they can accept it. That there's also enough options to kind of incentivize other management team hires and whatnot, as well. Then from there, there's other consideration, liquidity preference, ratchets, what else? Board seats and stuff like that. So it's not, valuation is one piece. Maybe it's like 40 to 60% of the piece, but it's not the whole thing, right? So other stuff are just as important.
It's also the terms, I suppose, that's really what you're getting across, right? It's cool you priced at X, but what else goes along with that?
Exactly. And you never want to negotiate anything like in isolation.
Yeah,
right. Gotcha. It's a package that matters.
Mm-hmm. And when it comes to exits, how do you evaluate and prioritize an exit opportunity? So, for instance, let's just say Startup 9 gets an offer to acquire. What role do you play in that? And walk us through how you approach an exit opportunity.
Yeah. The question that we ask is, why is similar would be first invest? Why now, right? Why do we exit now, right? Is this the right time to exit, right? If it is, then and if it's been pre-planned, right? And we got the term sheet because this is kind of like thoughtful, intentional thing that we've been driving towards, then sure, because we expected it. But when it's sort of a random term sheet coming out of nowhere, yes, it's not usual that we got a pleasant surprise, right? It means that, we might actually be onto something. And they don't want us to keep going because it gets more expensive. That's why they want to do it now. That's sort of like the distinction. But answering the why now exit question is important, because then it dictates everything else. It dictates like, should we do it? Should we not? What's the price? What's the potential? And then we can kind of think about, all right, if we don't exit now, like what's the path forward? How long would it take? And that's sort of from a fiduciary board member kind of hat, right? But then from a VC hat, that's a different hat, because then you have to look at the life of the fund. Like, is this 7 year or is it 12 year? And if it's 12 year, it changes things, right? The hard part really, because we serve on a lot of boards, is bearing those two hats, because sometimes, what's good for the fund is not good for the company. The fiduciary is important in that case. I'm not going to say, like any VC is human being, we're going to get influenced by our other hat, our non-board hat, right? But from a business first standpoint, the why now is the thing that we ask all the time.
That's a really great point, because I think timing is so important. Because oftentimes what's a deal today won't be a deal tomorrow. But I hear you, sometimes, acquirers, they say, hey, we're interested in acquiring you, but they just want to see what you built, but they don't actually have any serious intention behind it.
Yeah. And typically, like these conversations doesn't come out of the blue, right? Let's say like a medtech company, there's like a handful of company who acquire, right, in that particular space. And typically they've talked to each other for like years, sometimes even before we even meet the company. So they do have that preliminary information, but it could be that they want more, they want to dig more into it. I don't know if they've come across the case where they're outright trying to try to understand a trade secret and run. All right, that's not as usual. Yeah.
I hear you. So let's talk about the kind of future here for a moment. So when you think about venture capital, what keeps you up at night currently with your general partner hat on? Is it the performance of the portfolio? Is it getting returns, an appropriate return for your LPs? What keeps you up at night?
Yeah, I'd say it's to make sure that the company doesn't get short-sighted because of the pressure of the cash crunch. we don't want a company to be in a slow death kind of mode, where they're doing it, they're cutting the burn and stuff, and they're basically never going to recover. Right? This is also as good as death. It's just a slow death. It's just even more painful death. So balancing that, how do we balance? All right, let's make sure that you're still taking some level of risk. It's an intelligent risk. It's going to set you up, for success. You still are growing. You're going to burn. And, we're going to need to have some assumption of when the capital market is going to resume to some shade of normalcy. Right, because the reality is we do have 300 billion in dry powder. It has to go somewhere, unless the pension and endowment of the world start, sovereign wealth funds start defaulting, right? Which I think is a pretty rare case that's going to happen. So let's make that assumption, and let's take the risk based on that assumption, and we can kind of like vary things a little bit. But what we don't want to be, hey, we're not going to grow at all because we're just going to conserve cash. Well, if you're not going to grow at all, then how are you going to show the matrix that there's this fast growing business? Then even when the capital market resume, you basically lost that chance to raise your Series A. Then it's not any good either, right? And then you're going to start ramping up. Then you realize you have even less money to do that than you did 6 months ago. Well, that's also not good. So let's take the risks. Let's talk to your core investors, what they're willing to pony up if they're growing, they're burning, and the market has not yet resumed. How long can we continue to bridge that?
Yeah, that's a great point. And when you think about the future, let's just say fast forward another 10 years, how do you see the role of venture capital evolving, and what do you think its impacts will be on startups?
That's a good question. We've talked so much about how VC model has never evolved for the past 40 years. Frankly, I don't see a force that will make it change, right? I mean, there's more capital coming in over the past 10 years, right? So that has spurred up innovation in so many different ways. I think the most recent things in a couple of years is a big push in terms of diversity and ESG and all of that from the LP. It hasn't made that meaningful impact. I think in many ways, as much as VC like to think of ourselves as, hey, if it's spurring innovation, kind of a bit of a dinosaur sticking to the same model, right? And that people obviously trying to out innovate the model and everything, but the big check still goes to the old model, right? The 220, the traditional closed-end funds. Then you have Sequoia to basically go, with the evergreen model and everything, and that's changing a little bit. There will be more. I believe that there will be more intermingle between hedge funds and VC fund, where VC fund become hedge fund become VC private funds and stuff. I think that's a trend that's going to keep going, especially on the software side, where it's starting getting commoditized, right? In a way where people, now they start to know how to do software investment more and more, and then you see Tiger of the world jumping in. So that will continue to happen. You continue to see more niches of VC coming up on the early stage, because that's the only way to survive, is to specialize, not generalize. But short of that, I don't know if there are the big impending forces that's going to completely change the way we do things compared to the way we're doing it today.
Yeah, it's just by the way, there's a book I'm reading called VC in American History. And I don't know if you've read it, but it's actually the venture capital industry hasn't really changed since the whaling industry in the in the 1800s. It's literally the same. It's just called different things, different context, but otherwise structurally it's the same.
Right. Yeah, and the question is what's so broken about it that the industry decided to change? Right. Sure. 60% of the money go to white guy, blonde hair, blue eye from Stanford, Harvard, right? So it's not great. I'm not saying that's great, but fundamentally it hasn't broken from an economics point of view, right? Just still, VC funds are still generating enough return so that garner more and more capital from the LP. So until that that economics break, there's no real economic pressure to change. And it's difficult for people to just change it because, it's good for the world, right? I mean, if that's the case, we wouldn't have climate crisis. So yeah, there wouldn't be a whole lot of other issues that we have in the world if that were the case. It's hard. It's hard. Yeah.
Yeah. Let's wrap this up, Champ. So if I could give you the keys to the Matt Brown Show time machine and you could go back to yourself on day one of this whole venture capital, journey that you've been on, what advice would you give yourself about venture investing?
Oh, don't do it. I'm sorry to pun, don't do it. It is so fucking hard. I mean, I'm serious. I tell everyone this thing. Like, if I had known the first day how hard it would be, I'd say, like, don't do it. No, I mean, it's partly a joke, right? What I'd probably say is it will be hard. It'll be fine. But keep pushing. You'll figure it out. And that's the advice I give to all the entrepreneurs. It's going to be way harder than whatever you think now. It's going to be like 10 times harder. You just don't know it yet. But you know what? It'll be completely okay, because as it gets exponentially harder, you also have to get exponentially better. It's a forcing function. You either grow or you basically die. And it's going to be a wonderful experience no matter which side you end, because you're going to learn so much and grow so much, and you're going to appreciate all those pains so much. But just know it's going to be painful, and it'll be completely okay.
And on that bombshell, it's time to end. Champ, I dig your vibe, man. You're a great guy. And I love what you guys are doing in the deep tech niche around venture investing. So congrats on all your success so far, and exciting to see where you guys are going to go in the future.
Thank you, man. Thank you for having me.
Anytime.
Yeah,
Cheers.